This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call this Thursday morning. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, Prashant. Good morning. Hi, Nigel. Morning. So the big rate hike has come and gone. And it would be interesting to see if the market moves on, right? And whether it resumes the buy on dips or not.
Well, I think, the Indian markets out here, the traders, they said, let's factor in some bit of disappointment. Last couple of days have been pretty much muted. But they did what they were expected to do, right? Prashant, more on that.
Absolutely. Who was up, by the way, watching the Fed meeting?
None of us.
I know someone from the newsroom who was up, not me.
No, I wasn't up, but the Mumbai Indians game was quite interesting. And, we came out, Trump's then packed up and went to sleep. No Fed.
All right. But, if one was hoping that the meeting is going to be very decisively informative, that was not to be, right? I mean, it was a little bit of this, a little bit of that. But we have to distill it down to takeaways for you. And that's what we're going to do. So the message from the Fed, if you want to kind of take all of it in, was that this is a reading. This is, in a way, the summary of what the Fed meeting was about. The message was that we are getting close to the end of the hiking cycle. I mean, I think that came out more clearly as compared to any time in the past. That's point number one. The reason why this was seen to be so is because the Fed dropped its forward guidance, which basically said that we anticipate more rate hikes. That particular quote was dropped. Actually, there were a lot of changes in the statement which the Fed put out. And they said that we will go by data and we'll take a decision meeting by meeting. The press conference, right? The statement was the statement, but the press conference had something for the bulls, something for the bears. So, while he said all of this and he did indicate that we are perhaps to the close of the hiking cycle, he did push back. Fed Chair Powell did push back that maybe the market is pricing rate cuts too soon. He said if their view of data comes true, then rate cuts will not be warranted this year, etc., etc. So there was a little bit of this, a little bit of that. And that's why I'm saying that if you were looking for a very decisively informative sort of meeting, this was not it. The market reaction also told you some of it. The S&P was down. It was in a tight range, and towards the close, it came under pressure, 0.7% lower. The US 10-year yield was down 9 basis points. Just take a look at what has happened this week. We started the week with a 15 basis point jump, then we saw a 14 basis point cut, then we saw a 10 basis point jump, and now we're down 9 basis points. So it's not moved very much. 3.34 on the US 10-year is where we left off. Now, post-US close, and I think this bears watching, it came after US markets are already shut. Another US regional bank seems to be in trouble. There was a Bloomberg story which said that they're looking for suitors and they're looking for options, and one of it could be perhaps considering a sale. So this needs sort of watching in terms of how this progresses. By the way, the Fed chair in his press conference did address the bank issue. He said that overall the system is pretty healthy, and then we get this after close. So it's a volatile kind of situation. Stocks in the regional bank index post-close did correct quite a bit. Oil prices have come under pressure, and they're now down almost 10% in 2 sessions flat. So in a way, oil markets are, and this is broad macro concerns, it's not some data on inventory or anything of that sort. So the oil market is pricing in a much more severe, a deeper recession. Will it come true? Will not? That's a different thing. Equity markets are not. So perceptions at this point in time vary quite a bit. Let's come to the market here. Yesterday, we had a negative daily close, both on the Nifty and the Bank Nifty. Towards the close, of course, the market recovered a little bit. On the Nifty, I'll start with the lower levels. The lower end of the rising channel now stands at 17,920. And that's the support level, which you need to kind of put in place and should not be violated if you're trading. On the upside, a break above 18,180 should be watched for more upside levels to materialize. 18,180 is the level to watch. For the Bank Nifty, again, starting with downside levels for approximately around 40, actually it's about 43,010 or so. 43,000 will be the near-term support level. And that's something to watch closely. On the upside, a break above 43,484. I mean, both these levels on the upside on the Nifty and the Bank Nifty are levels, the highs which were made day before yesterday on the respective indices. So the Bank Nifty 43,484, a break above it will indicate further higher levels to come. We are, as I said yesterday, in a bit of a state of flux market, a lot of times it so happens that US market reactions comes more forcefully, not on the day of the Fed decision, but a day later. Views are crystallized, people are more clearer about what they want to do, etc. And of course, there is new information in the form of this bank thing as well in the US, regional bank thing in the US as well. So we kind of remain in a similar kind of state where we were sort of yesterday when we started the session. So maybe in a bit of a no man's zone once again. And this is important given the fact that we've rallied quite a bit very, very fast over the last 4 weeks or so. 18,100 or so is what the SGX is indicating in terms of a start. Sonia.
Oh, absolutely. And I think this morning, the disappointment is not more to do with the rate hike, but it's more to do with the fact that rate cuts are off the table. At least that's something that the Fed has said. It's a certain degree, degree of certainty that rate cuts are not on the table anytime soon. So the market mood is a bit somber because of that. Of course, they also mentioned that they are closer to the end of the rate tightening cycle and not the beginning. So in that context, perhaps no more rate hikes, but rate cuts not on the table anytime soon. So that's the reason for the market dip that we saw overnight across the globe as well as on the SGX Nifty. But all eyes will now be on the initial jobless claims data that come out today. The payrolls report comes out tomorrow. So in that context, we have a lot of global data to reckon with over the next 48 hours. The Nifty yesterday closed above the 18,000 mark. There were minor cuts that we saw. FIs continue to buy, which is a good thing. So FIs bought about 1,400 crores in the cash markets, while DII sold about 583 odd crores. So, flows are a bit muted on the DII side, but FIs, continue to see the momentum. So the big question that I'm asking myself is, will the market resume its buy on dip strategy? And that could be tested today once again, because the SGX Nifty is indicating a muted start. There are a lot of earnings to track as well. Today you'll have names like HDFC, Hero MotoCorp, TVS Motor, Adani Enterprises. There's Dabur, United Breweries, all of these companies announcing their numbers. So we'll keep that on our radar. And Titan is the big one that reported its numbers post-market hours yesterday, largely in line with estimates, actually. There were no major surprises either way. There was just a mild miss in margins, and especially in the eyewear business. But otherwise, the revenues were actually a beat led by the sale of gold ingots. So, that's something that I don't think the street will react to too much. They were largely in line with estimates. But as we were saying, the big question now, I guess, is whether the market resumes its uptrend. The fact that there won't be any rate cuts anytime soon. And I think a lot of people were hoping for that to happen, that once the rate tightening cycle ends, in the start of the new year, there could be rate cuts. But no, that's out of the picture. So maybe the market's sulking because of that.
Maybe, Sonia, the SGX Nifty is suggesting a bit of a downtick, which I think is not such a bad thing. The last couple of days, the Nifty has been more or less sideways, a little bit lower. We've come off 100 points in the last two sessions from the Tuesday high or so. But today is weekly expiry. So the options data becomes very, very important for today. Now, we have lower crude prices overnight. You have a weaker dollar as well. This is a tailwind for emerging markets and India in particular. The bulls have positioned themselves that they can defend the 17,950 to around 17,975. So given that we like to start off on the back foot, maybe a buy on dip strategy will work out with that stop loss at around 17,950 odd. What do the FIs do? They're back to their shorting ways. Now, that's not such a bad thing. We want some shorts in the system. That's what could give an additional fillip on the way up. If they go net long, then you're only counting on their cash market buying. So yesterday as well, they added close to 9,000 short contracts. The short position goes to around 54% odd. On the option side, they bought protection. They bought more puts than calls. So close to around 2 puts is what they bought for every 1 call. But the heartening fact is that they continue to write puts. And that's a good sign from a bullish perspective. And the options data, the Nifty Bank, well, yesterday we did see the 43,200 put. That added a fair bit of open interest. The rough premium out there would be around 180 odd. So those put writers, they are suggesting that that 43,000 level should hold out. That's a crucial support zone on the Nifty Bank. On the Nifty, the 18,000 put has the highest open interest. So that's why you're counting on the lower levels holding out. Though on the upside, call writing is quite aggressive as well. 18,200, 18,300 call. Both of them added close to around 50 lakh shares between them, which brings us to the levels. The recent high is around 18,180 odd. That's a bit of a resistance zone, 18,150 to around 18,180 going by the options data. And on the downside, the 17,950 to around 17,975. That's a crucial zone. My guess is that today, risk reward could favor you if you get that 60-70 point downtick, closer to around 18,000 with a stop loss at around 17,950 odd. So let's see how this one goes.
All right. Well, 18,100 is where we are at on the SGX Nifty at this point in time. Well, before we go any further, let's quickly tell you what's lined up in the first half hour of the show. We'll get you updates from markets across the globe. Jahangir Aziz of JP Morgan will be joining in for some discussion there. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At 8:30, Deepan Mehta will be joining in to talk about individual stocks and what he likes, what he does not, and comments on results as well.
Okay, well, let's kickstart with some opinion coming through on the equities front. We have Eric Fishwick of CLSA who says the Fed has raised rates by 25 basis points. He expects no further hikes but rejects the idea of early cuts. He says evidence that the labour market is finally starting to ease will keep yields contained and the US dollar soft.
Jonathan Garner of Morgan Stanley says a prolonged process of resetting the US federal debt ceiling over May or June could trigger corrective price action in cyclically exposed markets and sectors. For Asian equities, he says a key mitigating factor versus the 2011 episode is that growth is still accelerating in absolute and relative terms versus the US.
Let's also get you some money market views and tell you how to approach that market. Parul Mittal Sinha of Standard Chartered says the dollar INR edged lower on dollar weakness and a drop in oil prices, even as consistent dollar purchases by PSU banks capped the down move. She expects the dollar INR to trade in a range of 81.45 to 82.10 for the next week, post a much expected 25 basis points terminal rate hike by the FOMC. She says apart from the dollar and oil prices, dominant forex drivers would be flows into domestic markets, which have been positive recently, and RBI's continued efforts to build forex reserves.
On bonds, Parul says that domestic bonds rallied, tracking global rates, a cooling in oil prices, and expectations of a benign inflation outlook. She expects the 10-year benchmark bond yield to trade in a range of between 6.95 to 7.15% next week after a 25 basis point rate hike by the FOMC to 5 to 5.25%. She says while the data-dependent FOMC is still left some room for a potential future hike, market believes that the Fed has now entered a prolonged pause before it starts cutting rates by the end of 2023. Apart from global trends, she adds a key domestic trigger for markets would be April CPI data, which is expected to be sub 5%.
All right, we have a lot of stock-specific action that we're tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at Big Boy, Reliance Industries, ABB India, Cholamandalam Investment, Tata Chemicals, Sula Vineyards, as well as Sona BLW. They are stocks on the back of positive news flow, while on the flip side, you have Titan, Abbas Financiers, Petronet LNG, and KEC International that could be reacting to negative news flow.